Okay, we're live. And let me go ahead and share my screen here. We're talking inherited IRAs and being the son or daughter of someone who inherited an IRA from their parents. So we're going to go through this flow chart here. I'm Eric Maldonado, and we're looking at 2025. How must I take distributions from the traditional IRA I inherited? Let me get my annotation going here. Let me see, make sure it works. Okay, good. So this stream in particular, we'll be talking about the scenario of a child or, the son or the daughter of a deceased parent. If that's you, my condolences. And you inherit an IRA. So your parent has an IRA and a traditional IRA, and they left it to you to inherit. And there's specific rules. Leave it to the IRS, of course, to leave a bunch of rules and kind of complexity to figure out what you're required to do as far as the inheritor of the IRA and distribution rules. There used to be a time where they were much easier, much less nuance. You used to be able to stretch out an IRA for your lifetime if you wanted to. Now, what they called that the stretch IRA. Now the stretch IRA has pretty much been done away with, and they have these 10-year rules. And even within the 10-year rule, which means you have to take the money out within 10 years of the deceased's, date of death. Within the 10-year rules, there's also required minimum distribution rules where you have to take out a certain amount of money each year, possibly. So we're going to get into those details and nuances. I'm going to try and simplify it for us. So let's start here. Was the deceased owner of this traditional IRA the original owner? In this example, we're going to say yes, they're the original owner, versus what's considered a twice inherited IRA. So if someone inherited an IRA and then you inherited an IRA from them, we're not doing that at this point. We'll look at that at another time. For now, we're looking at if you inherited an IRA. Specifically, we'll look at from your parent. So this would be a non-spouse. So did you inherit this traditional IRA from your spouse? The answer would be no. There's different rules, but yet again, more rules for someone who inherited an IRA from a spouse. They're a little bit more favorable, you have more options. However, let's just stick with the scenario here of someone inheriting an IRA from someone who is their parent in this example, just to keep it simple, because it's a pretty common one. This is probably one of the most common inherited IRA scenarios outside of the spousal IRA. That's a very common one. Someone's spouse passes away. This one is someone's parent passes away, and what to do and how to do it. It's just so nuanced and complex, and the rules are always changing and have been changing for the past few years now with the Secure Act 2.0 and things like that. So next question, our flow chart here. Did the owner of this traditional IRA pass away after December 31st, 2019? For this example, we're going to say yes, because it's just more relevant. Let's just say, God forbid someone had a parent pass away this year. It's 2025. So that's well beyond 2019. That's when some of the rules changed in 2020. We can look at that scenario next in case someone's watching this and they have an inherited IRA from someone who passed away before 2020. But for now, let's go with most relevant. We're going with someone who has an inherited IRA that maybe just happened this year, and you want to make sure to get the distribution rules right. Maybe you've read online certain things, or you heard two different things from two different advisors. That's pretty common. So let's clear it up here today. At what time at the time of the owner's death, were you a minor child, so someone who's less than 21? Were you less than 10 years younger than the owner? No, because you're the son or the daughter. And were you disabled or chronically ill? So those are different scenarios. Those would be considered eligible designated beneficiaries. Currently, we're saying we are the son or the daughter of the deceased, keeping it simple on this one scenario here. So in that example, you are considered, believe it or not, a non-eligible designated beneficiaries. It's not too important to remember this non-eligible part, but that's for whatever reason what they call it. Non-eligible meaning there's not like these different exceptions that come into play, like being disabled, being a minor, being less than 10 years old, being less than 10 years younger than the deceased, chronically ill. So this is just a scenario where you're the son or the daughter of the deceased parent, you're trying to figure out how to do your distributions for your IRA. Now there's two scenarios. One is, did the owner of the IRA, so this would be your parent, did your parent pass away on or after their required beginning date? So sorry for all this jargon, RBD they call it. Another thing you might have heard is required minimum distribution. In other words, had your parent already started their required minimum distributions? Because that'll affect how and when you have to take the money out of this IRA to avoid the penalty. And what's the penalty currently? Currently, if someone doesn't properly take out the required distributions from their inherited IRA, 25% per year, which is a hefty penalty and pretty ridiculous. There are ways to get a exception if you were just unaware and you have to file a tax form. Tax form is 5329, I believe, and you can get the exception down to 10%, or you can get it waived. But hopefully we just never have to be in that scenario. The penalty actually used to be, believe it or not, 50%, 50% per year if you missed an RMD. So let's say the RMD was, $20,000. The required minimum distribution amount was $20,000 a year. You would get taxed an amount of $10,000. That's crazy. So it behooves us to know these rules properly and to take the money out. And a good advisor should be able to help you with that, or like you're doing here, doing some research. So did the owner pass away on or after their required beginning date? So let me speak to what the required beginning date is. So I'll put in a little shape here. Let me go with I'll go with green. So currently the required beginning date is age 73, and we go with white, 73. So if your parent was turning 73 in 2025, let's say, just we're making it up in imagination of someone dying in 2025 and they were 73 years old, then they would have had to start taking their distributions. In the year 2023, it'll actually be 75. So we get a little bit of more, Congress has given us a couple more years before they start making us take distributions. It used to be age 72. That was from years 2020 to 2022. So this might be a little bit extra information, but I like to give the full background. And then for a long time, it was age 70 and a half. So you may have heard that. You may have heard that age. It used to be age 70 and a half. Again, leave it to the infinite wisdom of the IRS and Congress to put a half year in there for an age. It just made it even more likely that someone would do it wrong and possibly get penalized. That was pre-2020. So currently, we'll just say in this example, we're asking if someone passed away in 2025, were they age 73 or not, to determine how much to take out of the RMD, or take out of, to determine how much you have to take out per year. Let's just say for this scenario, the answer is no, the owner was younger. Let's say they were 65, 69, 70 when they passed away. They did not start taking their required minimum distributions quite yet. So they hadn't started their required beginning date. So in that example, you must follow the 10-year rule and ensure that the account balance has been withdrawn by the end of the 10th year after the year of the original owner's death. So this is actually a little bit more of a favorable mandatory kind of distribution rules. This one you have 10 years. So we used to be able to stretch it out over lifetime, which was a benefit, because when you take distributions, every year you take them, you have to pay tax on those distributions. But if you can take a little bit out for your whole life, for the rest of your life, then you avoid paying a bunch of tax in one year. and you're able to stretch it out for like a lifetime income possibility. Now, or my guesstimation is that the government wanted to get taxes sooner because we're in just higher national debt levels, and tax is the way that the government gets revenue. So they're saying, hey, we want to get this money within 10 years. And so the inherited IRA beneficiary has been kind of the casualty in that scenario because we can't stretch it out for life. One more thing on inherited IRA, you know you have an inherited IRA when on the registration of the account, when you inherit an IRA, it'll have your name, depending on the custodian you use, Schwab or Fidelity or Vanguard. It'll have your parents' name, and it'll say typically, beneficiary of your parents' name or for the benefit of your name. And it'll either say inherited IRA or beneficiary IRA. Those are two of the same thing. Beneficiary IRA and inherited IRA are interchangeable wording. So if the parent hadn't started taking their annual distributions yet, they were a little bit younger, under age 73, then you have 10 years to take out the money. So let's say the deceased was in 2025, you have to take out the entirety of the balance by the end of year 2035, 10 years, starting in the year after they deceased. And then let's go with a little note here. So be mindful of a future potential tax squeeze when following the 10-year rule. What does that mean? It means consider taking additional voluntary withdrawals, even if not required, to spread out the tax life distributions over the 10-year window, if it makes sense for your situation. So the caution is if you wait all the way until the 10th year, the year 2035 in this example, if someone passed away in 2025, and let's say it's $1 million of an inherited IRA, you're going to recognize $1 million in that year, and so you're going to be in the highest tax bracket, as opposed to you took out a tenth every year. Maybe you would have been in the second or third highest tax bracket as opposed to the highest tax bracket, and that's where you would consider taking additional voluntary withdrawals just to spread it out and be a little bit more, tax aware. The other scenario is, yes, if the parent died after they had already started taking their required minimum distributions, and you would know that based on the statements. You would want to get the previous statements of the IRA, maybe even get on the phone, and an advisor would help you do all of this. But if you were doing it on your own, you would be able to tell on the statements if they were already taking required minimum distributions, outside of the fact that you would have their death certificate, and it would show the date that they died, obviously, and if their age was 73 or older, then they would have been taking RMDs. So what happens in that scenario if someone is inheriting an IRA from a parent that already started taking their required minimum distributions? Well, then you have a little bit less flexibility. Now you have to follow the 10-year rule, and you have to take annual required minimum distributions over the longer of your life expectancy or the deceased owner's life expectancy. So it would be your life expectancy if you're inheriting from a parent, obviously, because they would be older, you'd be younger, so your life expectancy is longer. So basically, you have to, in addition to following the 10-year rule, you must also take RMDs over the longer of your life expectancy. So there's an advisor would help you figure out the calculation. There's also calculators online. You can potentially ask the custodian of the account for help. They may be able to help you do some paperwork to figure out the calculation to properly take out the required amount. So in this scenario, you have to take out the RMDs as well as the as well as take it out by the end of the 10th year. So I'll go ahead and summarize it here for us in this scenario. You're gonna have to take out money every year. Every year, take out money. called a required minimum distribution, and you take it all out by the end of the 10th year. So it's and both in this scenario. This time you don't have the flexibility of choosing which year you want to take it out. This time you have to take it out every year required, and you have to take it out all out by the end of the 10th year. Okay, so let's go ahead and delete this part here. And let's read this little note here. Get a little additional information. So, too far. Sorry about that. The 10-year rule, if applicable, and or your annual RMDs begin the year after the death of the prior owner. For RMDs in the following years, subtract 1 from the initial life expectancy calculation. So this is kind of giving you a little bit of a instruction on further how to calculate the RMD, which there's calculators, and the custodian should help you if not an advisor. Additionally, you must satisfy the RMD for the current year if the prior owner hasn't already done so. So this is actually a really good reminder that you'll have to be aware of whether or not your parent had taken out their required minimum distribution already. Maybe they passed away earlier in the year and they were going to take it out at the end of the year. So you would have to know that, so that way you take it out and they don't get penalized. And you would have, I believe, until the end of the year they were supposed to take it out. Unless it's the first year of the RMD, then you can take it out until April of the year later. If that's too much detail, just remember that you want to just double check and make sure if they had to take out RMDs that they did it in the year they deceased. Otherwise, you'll have to do that for them. It would just be an additional distribution to you as the beneficiary. Okay, let's look back here and see. So that's the main scenario. I'll go ahead and summarize here. So the scenario is for someone who is a son or daughter and you inherited an IRA. If the parent hadn't started their required distribution, so if they're essentially less than age 73, you have 10 years to take the money out. If the required minimum distributions had already started for the parent, RMDs already started, you have 10 years to take the money out, and you have to do an annual RMD. So that's important to know. Okay, I'll go ahead and erase this here, and let's just look at this scenario just in case someone has the question of whether or not, of what they need to do in a scenario where they inherited an IRA, and in this example they're the minor. This person would be a minor, so less than age 21, or you were less than 10 years younger than the owner. So that would probably be a scenario where you were like inheriting a sibling's IRA, maybe a friend, someone who's more of a peer, more same age range. Or if the inherited person has a disability or is chronically ill, you have a little bit more flexibility on how you take RMDs. So you would be considered an eligible designated beneficiary. And again, you have to ask the same question. Did the owner pass away before or after their required beginning date, meaning before or after they had to start taking distributions? If the answer is no, let's say they were younger, they were in their 60s or before they had to take required minimum distributions, then you have a choice. You can either follow the 10-year rule with no RMDs. So basically you have to pull the money all out within 10 years, or you can take the RMDs over your life expectancy using the IRA single life expectancy table. So this is still allowing what's considered the stretch IRA, which is nice. It's a lifetime option to have a lifetime income stream. If you're able to do that, you can take out and invest, defer taxes even longer, which is the whole reason for the IRA to begin with. And there's a little caution here or reminder that if you are a minor child, so let's say someone is inheriting in their teens or a teenager, you can stretch it out as a lifetime distribution, but once you're the age of majority, so or once you're the age of 21, you now have to take the money out subject to the 10-year rule, meaning once you're 21, you have to take all the money out within 10 years because now you're the age of majority or an adult. And then what's the answer if you were an eligible designated beneficiary? So someone who is like a peer of the deceased, a sibling or a friend, you're within 10 years of their age, or you were a minor or disabled or chronically ill, and the person that you inherited from already started taking their required minimum distributions, then you must take RMDs over the longer of your life expectancy or the owner's life expectancy. And the 10-year rule does not apply to you, which is great. You have a whole lifetime to be able to defer taking all the money out, so you can use it more as a lifetime income stream. And then again, the same thing, if you're a minor child, you will become subject to the 10-year rule starting at age 21. So once the child becomes 21, then the 10-year rule kicks in and they have to take all the money out within 10 years. And let me go through one scenario here that we missed, which is if you happen to be listening to this and you have basically an old inherited IRA. So essentially you inherited an IRA from a parent that deceased before 2020. So the rules are a little bit different. The rules change in 2020. So if you have an old inherited IRA and you're just curious on if you've been doing things properly, then you would want to follow this line of thinking. So did the owner of the traditional IRA pass away after December 2019? We're going to say no. This was before, so it's an old IRA. Let's go ahead and follow the flow chart here. And then again, same question. Did they already start their distributions? If they did, let's say they were older and they already started them, then you must take your RMDs over the longer of your life expectancy or the deceased owners, and the 10-year rule does not apply to you. So basically you would just be taking the RMD calculations every year for life. And if they hadn't taken RMDs yet, if that person was younger, maybe like in their 50s or 60s, then you take RMDs over your life expectancy, unless you elected the 5-year rule, which pretty much no one would really elect that to have to take out everything within 5 years. You wouldn't do that. The 10-year rule does not apply to you. So basically, if you have an old inherited IRA from someone who passed away before 2020, then you still have the stretch IRA option available. So most people listening to this video probably wouldn't apply, just because that's 5-6 years ago now. And then for RMDs in following years, subtract 1 from the initial life expectancy calculation. This is more just helping you figure out the calculation, which there's calculators for that. If you have questions, you can reach us at our website here, aquilawealth.com. If you want a copy of this flowchart, you can email me at info@aquilawealth.com, or put a comment and ask for a copy of it. Thanks for tuning in, and until next time.